So welcome back to the R&D Room Live. We're going over TastyBites for small accounts, trading options, and I'm doing this because I want to learn more about the Tasty Way, and I want to take you along my journey, documenting and going through what we can learn along this journey. There's many videos out there. We started from the beginning of 2013. We're now in April 10th, 2013, and they've got videos spanning all the way up till now. And they do them less often in the future, but they have really good studies, really good tips for people with small accounts. And I think it's very important that we take our time and learn what they have to say going through focusing on our small accounts. So I'm somebody with a small account, less than $25,000, and I want to follow the TastyTrade way. Whenever I started trading options, I was doing the wheel strategy, which was one strategy. It works really well. But I want to expand my learnings and follow what they have to say. So I want to take you with me there. Let's go ahead and get started and listen to the video. I've got a pizza in the oven, so bear with me. I'll step out. I'll be listening along with you, and then I'll be right back. So let's play.
Let's do TastyBites today, and let's do it with breaking down actual trades. Our producer
just said the Fed pulled a Google.
The Fed did pull a Google. It looks like, but who knows? It was intentional or not. Hey, let's look at this the way our producer Tony V wanted us to look at the earlier segments this week on scaling, which is breaking down TastyBites with actual trades. So thinking that maybe some of our viewers will get more out of it. So yesterday afternoon, when I finished the Where Do I Start segment with Case, I turned to her and I said, think about two things overnight. Okay, think about FXY, which is the Japanese yen, because it's still in a downtrend, and maybe you'll have an opportunity to do something at good prices. And think about JCPenney. What's JCPenney doing this morning, by the way?
It was down around $1. JCPenney was up around 7 cents.
It's up 7 cents. Okay. So, and I thought about, okay, based on what I said to Case, you know what? Better than her just trying to figure it out on her own. Let's just break it down for her. And she's got a small account.
Fair enough.
TastyBites is about small accounts. Let's break it down using actual trade ideas, and let's talk about those two potential trades on a very small scale. And let's look at some of the factors. So I kind of wrote it all out.
We're going to start with JCPenney.
We're going to start with JCPenney? Okay. Bring it up, Linda. So JCPenney, the symbol's JCP. It's plenty liquid enough. It had about $1. It had almost a $2 move yesterday after firing the CEO or quitting, whatever the deal was. Who cares? But it's out. News is done. Let's talk about staying small and thinking about some of the aspects of the trade that I asked her to look at. The trade I suggested to look at was selling one. Remember, she has a $2,500 account. So I'm talking about very small amounts of capital, just trying to think about how this stuff fits into her portfolio mentality. Selling one of the May 13 puts at 92 cents. That's where it closed last night. I didn't know what the stock was doing this morning when I wrote this up. So selling one of the May 13 puts at 92 cents. Let's look at the next piece. It has a max 50% return on capital for 38 days. That means the amount of capital required to make this trade, and again, I don't have the exact numbers, but I think it takes a little
51%.
Okay, so it takes a little it takes a little over 2 times that 92 cents to hold this position. So it's got a max 50% return on capital for 38 days. Let's go next one. There's a 67% chance of it staying above your break even. Your break even is 13 minus 92 or 1208. Okay, and a 57% chance of keeping the entire credit. That is based on real numbers, last night's closing bid-ask prices, which were only about a penny wide or 2 cents wide. So a 67% chance of staying above your break even and a 57% chance of keeping the entire credit. Number 4. By using just 10% of your capital, this generates a 36% annualized return. For example, if Case has $2,500 in her account and she was to use 10% of her capital or $250 to make this trade, which assuming that does, if she does this trade and there's 40 days to go to expiration, she does this trade 9 times a year, and this is the only trade she makes, she will generate approximately 36% return on her whole portfolio. So you're telling me that she doesn't have to do another thing all year? Yeah, that's right. Right. On a $2,500 account using 10% of your capital or $250, you wouldn't have to do another thing all year, and you generate between 30 and 35% return on capital. If that number is about maximizing return,
right.
But you wouldn't really maximize.
The stock stays above 13, and you take a full.
But I'm not talking about doing anything else. Right. Just this: by using 10% of your capital at a little over 1% a day, it generates a return of 36% a year.
It's amazing numbers in their own.
Well, they're not amazing. I mean, the numbers are. It's just mathematics. It's just math.
I get it, but when you put it down on paper and you think that the S&P has returned around 6.5% over the same type of average, that's amazing.
Okay, so when you think about lame ass money managers,
or you can put it that way.
When you think about how lame the whole industry is about not embracing a different mentality about investing, why should you take risk-free returns to generate 4.5% a year after fees? That's my point. Why would you pay somebody 1% to make 4.5%? That's
when that's available.
Hold on, without convexity. So what that means is without any kind of a down move.
Right.
That's at market tops with no pullback. Okay, there's no protection of principal in that number.
Understood.
Just like there's no protection of principal here. But if I'm not protecting principal, give me a chance to make 36%. Let's go next one. So it's about $320 for one contract, and then I use the maximum amount, okay, that I could find. Let's go to the next one. And it's cheaper than defining your risk. So Tony, if I was to do one spread that was, let's just say 5 points wide, now, you know, just let's say, because people say, well, why do I have to do the naked put? Why can't I sell the 13 put and buy the 8 put?
You could.
But then how much, really, what are you doing?
You're not really taking anything.
You're not really reducing your risk.
Right.
That's right.
Now, if you're in an IRA account or you don't have margin or something like that, then that might be an alternative.
It's different if you're doing versus return on risk, but return on capital, it doesn't even pay to spread this off, is my point.
Correct.
Let's go to the next one.
Because you're using the same amount of capital for the naked option as you would for the spread.
The JCPenney implied volatility is over the 80th percentile. Okay, so you're getting the rich volatility. Let's go to the next point. The earnings are on 513. So what happens here is, because you need to look at everything that's going on around you, you also have to recognize that there is, when you get into the last 2 weeks before earnings, so from the end of April, okay, you're going to have normal decay between now and the end of April. So what you're really hoping for is a small up move in JCPenney between now and the end of April. And the expectations for that to happen, which we're going to discuss at the 8:30 hour, are pretty reasonable, because on an 80%, or what I say, the implied volatility was there 90%?
It's 83%.
83%. Well, 83% implied volatility. You're looking at, okay, just expectation-wise, you're pretty much looking at about a 4.5% daily move, and a 4.5% daily move on a $13 cycle, about 65 cents a day. All you need is 1 or 2 days up, and if you just picture the number of coin tosses, okay, you're going to have an opportunity to manage a winner in here, at least 1 or 2 times before the end, but at least 1 or 2 times, 95% of the time, at least 1 or 2 times.
60% of the time, you're 100% right?
Yes, I hate to confuse people this way, but 95% of the time over the next, in 95% of the time, you'll have an opportunity to manage at least 1 or 2 winners over the next 2 weeks. And I know that sounds weird, and we'll get into more of that, but that's just how the numbers work. That's just an average of the breakdown. Is there another one, Linda? No. FXY, so go back to the start of JCPenney just for 1 second before I get into FXY, because I want to repeat these. So the trade that I'm talking to Case about is selling one of the May 13 puts for 92 cents. It's a max 50% return. That's return on capital for 38 days. There's a 67% chance of staying above your break even and a 57% chance of keeping the entire credit. Using just 10% of your capital, this is a generalization, generates a 36% return when you deliver a 1% return on capital on a daily basis. So you'd have to do that 9 times over the course of the year. It only uses about $320. It's cheaper than actually defining your risk if you were to spread that trade off. And JCPenney implied volatility is in the 80th percentile, and we already know that earnings will not. With the earnings on 513, 2 weeks prior to earnings, the amount of decay will slow down dramatically to about 50% of what it is now.
Because of the earning event.
But you still have 2 weeks before that, of which I think there's a 95% chance, and that's just based on what we call probability of a touch, that the stock will trade high enough to be able to generate a decision on whether you want to manage a winner, as well as low enough too.
Correct.
I mean, there's the same chance that it trades directionally equal to the downside, but that's just the game you play.
Going back to the 36% a year, you can take a look at that in the same thing as like pot odds. The pot odds for the year on a managed account, you're looking at 4 or 5%. The pot odds here is 36%. Which pot do you want to play in? I'd rather play in this one.
Of course. Plus, God help you if you learn something. I mean, we're talking about a 24-year-old, okay? I mean, I don't know, her, let's just say she's investing for herself for at least the next 40 or 50 years. She's a lot healthier than me, so we'll give her 50 or 60 years.
Sure.
Okay? So she's investing for herself the next 50 or 60 years. I mean, that's going to help her forever. Okay. Old saying, a young trader needs an advisor like a fish needs a bicycle.
Did you learn that when you pick up your shirts?
Yes.
Good
Okay.
boy.
Let's go to the next one, FXY. Selling the May 98.97 put spread. This is my FXY, which is the Japanese yen position. This is what I talked also to Case about. And here the problem is this is a much more expensive stock. It's a $100 stock. So on a $100 stock, doesn't have the capital to sell a naked put.
Vanessa told me that's Gloria Steinman, by the way.
What? It is.
A woman needs some.
Yes. It's an old, the first round of Women's Lib, that was the old, my sister used to have a button. So I got it.
Sister used to have a button.
Yeah.
She used to have a bra too, but that's another story. Talk about it another day.
Selling the May 98.97 put spread. Collecting 40% of the width of the strikes, or 40 cents.
I'm a feminist.
Oh, absolutely. C. Approximately 60% probability of success. Again, we're talking about FXY, which is a Japanese yen ETF. So we're not talking about a stock that has earnings. We're not talking about a stock that has any. We're talking about a global currency here. Again, we're talking about a global currency that is the trade's been very, very one-sided. We're talking about a global currency where this morning, Tony, the Japanese yen is actually even lower, almost making new lows.
Correct.
So selling the 98.97 put spread, collecting 40% of the width of strikes, or 40 cents. Okay, it's dollar wide spread collecting 40 cents. Having
You're
approximately
just looking at the closing prices
yeah,
from yesterday.
yeah, it'll be better than this morning. Approximately 60% probability of success. The max ROC is about 80%. That's your return on capital. The expected ROC is about 40%, meaning that that's what we're in the trade for. Okay, let's go to the next one. Two spreads only requires $120 in BPR, which is buying power reduction. So again, if you want to talk about getting small, two spreads only requires $120 in buying power reduction. So again, the objective here, put up $120, try to make a 40% return on that. And then when you start to work those numbers in, if your return on capital, okay, if you can generate that 1% return on day. Now, again, this is only 2% of our account. Okay, so it's a very different animal. But again, just working through the numbers.
Sure.
All risk is defined.
On that spread, yes.
On that spread. Keep going. The FXY implied volatility is in the 99th percentile. So you're talking about definitely has the implied volatility to support the objective here. And is there another one?
That's the last slide.
That's the last one? Okay, perfect. So let's go through this again, Tony, and just do it kind of fast. So in FXY, again, this is TastyBites. This is for small.
Before they go into that, he mentioned that this is in the 99th percentile, which is something that I've learned recently going through these videos. And I've added it to my TastyTrade watch list column because it basically gives you a piece of what the IVR, why the IVR is high. So the way that I see it is you have the implied volatility, which I learned recently too. There's a lot of stuff I'm learning through here. Looking at 39.6% here on the implied volatility, if we take a look at Amazon and see where do they get that 39.6% in implied volatility? If you look at Amazon, you see that it's very close to the 48 days, around 45 days, I believe. Was that right? 37.3, 30, let's see if I'm right here. More or less, I'm seeing that number is very close to the 45 days to expiration. Let's look at another one. NVIDIA's 86.6. See if I'm right. That's more closer to the 80. So it might be an average of these. I'm not sure, but it's decently close to 45 days. So that's what I'm looking for. And it could be that the market's closed right now and it's not reflecting accurately, but you'll find around that 45 days to expiration is what it shows there on implied volatility. So the IV percentile, though, which is mentioned in what he was just talking about, that FXI was at the 99th percentile. This IV percentile tells us how infrequent the implied volatility is, or how uncommon the implied volatility is. So 50 is the mean. So if we imagine a bell curve, 50 at the percentile of 50, that's in the middle of that bell. 84% is the first standard deviation outside above normal. If it's below 50, then you know it's below, the implied volatility is less than normal. You want to stay away from that because it, just like anything, it wants to revert to the mean. So you're looking for the IV percentile that is above 50 and even more, farther above 50, because the farther above 50 it is, it's farther out of normal. So definitely I'm keeping that on my watch list so I can break it down. Why is the IVR above 100? Or why is the IVR so high? And I can see that, okay, the implied volatility is high. Is that normal for the implied volatility? No, because it's 99.8 with the NVIDIA example, right? Implied volatility has gone through the roof just because volatility in general has gone up in the markets. But you're able to break down what that IVR is telling you. Is it the percentile? How high is the percentile? How unusual is this for this underlying? And then the IV tells us, how much implied volatility is there in that underlying. So you can break it down a little bit more than just looking at the IVR. You'll be able to see, is this implied volatility? How far out of the normal is this implied volatility?
small account sizes. And this is just continuing the discussion. Selling the May 98, 97 put spread, collecting 40% of the width of the strikes. This is the pure contrarian play. Approximately 60% probability of success just because of the theoretical value of the credit received. You don't have to know anything else.
On the May put spread.
That's right. You collect 0.4, you have a 0.6 probability of success. Max return is about an 80% return on capital. The expected return on capital is about 40%. You're going for that 1% a day. Two spreads only requires $120 in buying power reduction. All the risk is defined, and your FXY implied volatility right now is in the 99th percentile. That's the function of TastyBites, just so this industry and this business doesn't scare you away because the amount of capital you have is smaller.
Very good, sir.
It's a great, you know what, just getting introduced. Like, who would think about 24-year-olds doing a defined risk spread with a 60% probability of success in the Japanese yen?
Nobody.
And how does that hurt for the rest of your life? If you had done a Japanese yen trade when you were 24 years old, you never would have forgot it.
Correct.
You're like, what, 70 now? You never would have, like, you'd be 75 in 5 years or 10 years, whatever it is.
And I'd still be thinking about it.
And you'd still be thinking about that trade. Seriously, I remember the first time I traded Japanese yen.
Do you really?
Absolutely. I broke 2 golf clubs. I remember the first time I couldn't get a fill.
See, it was monumental for you. See,
It was monumental. I remember the first time I traded almost every product. I remember the first time I traded corn. I remember the first time I'm trying to think of things that we don't trade very often. I remember the first time I traded a soybean. You know, I can almost remember I remember the first time I
You're a
traded.
hopeless romantic.
I remember the first time I traded sugar, coffee,
I remember
copper.
the first time. I don't remember nothing.
Huh?
I don't remember the first time. They all blend in.
You remember the first time. You are so shallow. Are you kidding me? You got pictures to prove it. It's 8:20, and
Want to see?
we know. It's 8:20. We've got so much to do today. We're going to take a very short break. We're going to come on back. We're going to do opening bell, and I also have made a note to myself.
We got market measures, drag effect part 2 coming in. We got the X trader coming in later today.
But we are going to talk about an opening bell. Also, we brought up a topic yesterday on daily range, and we're going to talk about it a little bit because we confuse some people.
Go figure. We'll be back in 90 seconds. You listen to Get Tasted on the Tasty Trade Network.
Okay. Yeah, so they give us some things to look at here. Their thinking and, you know, kind of the metrics that they're looking for in a position, especially with a small account. So very tight put spread. They actually were able to collect 40% of the width. So that was really good. And 60%. So that was a really good trade right there for the time. So they got an extra return on capital, which that's not really a metric that they look at anymore, but yeah, overall a good trade, because typically if you're doing a dollar wide, depending on where they are on the delta, you're going to be getting a third the width of the strike. They got 40%. So 33, they got 40 versus 33. So really good trades, good finds there. And that's what I'm looking for whenever I'm trading options, is looking for the high implied volatility, high percentile implied volatility, and then trying to get around the 30 delta on my $1 wide put spreads. It just depends on how it looks, but yeah, really good trade there.
So
video number 2
requires less capital. This is not necessarily a segment for $2,500 accounts, or or it can be anything under $25,000. It doesn't have to be a specific. There's no specific dollar amount, except that you don't have the leverage or the opportunity in without pattern day trading rules. So the pattern day trading rules, which have been around now since the late 90s, limit you to how many trades you can make in the same underlying on a weekly basis for accounts under $25,000. It just limits you to buying and selling the same. It's supposed to protect you from yourself. It's supposed to protect you from churning. The concept of trading small, trading often, and the number of occurrences having a direct relationship to success never occurred to anybody outside of what we've done here on TastyTrade. So the problem is that the brokerage firms haven't been able to adapt. The exchanges haven't been able to adapt, and we still have issues with smaller accounts, making it more difficult to make money. And we think that we've got to either bridge that gap, or we've got to close, some way we've got to change the mentality of the smaller accounts, because you have to be able to manage your own money.
Correct.
You have to be able to do it yourself.
Doesn't matter what size your account is.
That's right. So TastyBites is designed to give you some ideas with smaller like trades, just to give you some, hey, you know what? Here's an idea.
There's a lot of things you can do with it.
Yeah.
Just because you have a small account doesn't mean that you have to be limited with your strategies too.
It is very difficult in stocks like Apple, which is a $420 stock yesterday afternoon, to be able to do a lot of stuff with a small account, because you're really limited and you can't do anything that's naked.
Right.
You can't sell it out of the money put. We sit here and say, well, a great strategy last night, which happened to work, was to buy a put spread and sell out of the money puts against. You can't do it.
Right.
A great strategy was to sell May volatility. Well, it's really hard to do.
in a Tasty Bite size account.
Right.
Correct.
So let's go on. Let's talk about some of the different underlyings and some things that are maybe opportunistic out there. Let's go to slide number 1. We tried a different. We tried one of our new research teams last night, helping to put this together. So we're putting that disclaimer out here. Typically designated as accounts that have a minimum of $2,000. That's to maintain margin status, and over $5,000 have the ability to sell premium, i.e., naked puts. That's kind of how we define it, which I think is really good to throw that up there. The $2,000 minimum is not a specific brokerage firm minimum. It's the industry minimum. It's set by FINRA and the SEC. The $5,000 number is not a hard-coded number, but it's the number that most firms, once audited, are required to live by. Thinkorswim had that same limitation, so did TD Ameritrade, and so does virtually every other firm. Just when it has to do with a little bit about suitability. There's no written rule. It's just what the regulators kind of request that you do. Okay, so that's why we come up with those numbers. Let's go to the next slide. We talk about bite-size accounts, and we talk about committing 20% of allocated capital, maybe about 4% per trade, and that's just all I did was ballpark some of the defined risk trades with some of the undefined risk trades. The game plan is to create an average of about 1% positive decay per trade based on buying power reduction. All we want to do is to get some kind of mechanics, whether that's $1 per every dollar you have in net liquidating value, whether that's $1 or 1% positive decay. It's just to get your mindset. It's just thinking about, hey, size matters, total commitment matters, and how much decay.
Correct. It's the same thing like looking at out of the money options and in the money options. It's just trying to train you into a guideline.
We never stop. We never stop the repetition part of the show, and we never stop the mechanical part of the show, because with all the crazy different directions we go to, we think it has to all come back to, and people are able to recite this now. People are able to kind of understand all that logic. Let's go next slide. We are currently.
So he talks about the allocated capital, and there he's talking about the buying power reduction, which he mentions before in earlier videos. But if you go to the capital requirement tab, you'll see a button called allocation, and this is based on buying power. So if you need to see, man, how allocated am I in each position, this will give you a general idea of your positions and how much of your account is being used by stock. It'd be interesting to see if you could do it by position instead of by stock. But either way, you can kind of see how diversified you are and how much your account is in each position there. So he is talking about buying power there.
Currently in the 1 week period where more companies than ever are reporting earnings. There are ways that Tasty Biters can capitalize on current market conditions, which means current market conditions, in this case, meaning earnings plays, binary events, primary events, just things that may move the market. We're also at an all-time high.
That's right.
And implied volatility is low, cost basis is high, implied volatility is low, but there are interesting things going on. Listen, Tony, yesterday in Apple, we talked about the May volatility being one of the best trades on the board. And it's going to work out that way today, but it's also the kind of thing where a Tasty Biter is looking at that going, you know what? I want to play.
Of course.
There's no casino game that you can't play really with, doesn't matter how much money you have. And the odds are against you in all of them. Here, you should be able to play, especially when the odds are in your favor. We shouldn't limit you when you have the best odds. Let's go next slide. So what we looked at today were a couple different stocks, just to have this discussion. Facebook, Groupon, Hewlett-Packard, US Steel, and Zynga. Let's think about these for a second. Facebook, a little bit on its butt. Groupon, right? Probably at the high end of its most current range, but mid-range for the stock. Hewlett-Packard, mid-range. And I'm calling it mid-range because the stock just was as high as almost 24 and as low as 16, so it's about mid-range here at 19 and change. US Steel on its butt, and Zynga kind of
in nowhere's land. $3 is where it's been.
Is it still $3 right now? And last time I looked, it's $3.26 or something.
Okay. Well, yeah.
I'm just saying, I don't know.
You're right. On a $3 stock, 26 cents does matter, but you're right. It's right around $3.15 or 18 cents.
Is that where it is? 3.18?
3.18.
Okay. So again, Facebook, low end. Groupon, mid-range. Hewlett, mid-range. X is on the low end, and Zynga, I don't know. Let's call it mid-range.
Sure.
Okay. Let's go to the next slide. So what we thought about is just, hey, let's take a look at some of these, and let's take a look at some of these earnings plays. I'll just throw them out there because what we wanted to do today was just, hey, you know what? Let's recognize some of the stocks that we can trade. So Facebook, for example, it's a $26 stock. Like I said, it's on the low end of its range for the last couple of months. The implied volatility is mid-range at 54.52% and on its way higher because it does have earnings coming out, which is on 5/1. In fact, Facebook was down in the 40s. Now,
40s IV.
40s IV wise, and now it's back up to 52 in the front. 54. It's probably going to go as high as 70 or 80.
Correct. Mid-range on the volatility.
Let's go to the next one. So Groupon is $6.36. It has IV of 76%. It has earnings on 5/8. Now we're pointing this out because we're starting off today's discussion with just some of the underlyings that are good, that are easy to experiment with. Okay, let's go to the next one.
HPQ.
Yep, I'm just waiting until it pops up. HPQ, 1965. The implied volatility is 34%, and the earnings are actually after. I believe 5/21 is after expiration, isn't it?
Look.
I think it's either expiration. No, I think it's after expiration. So.
Correct. The 21st is Tuesday after expiration.
Okay. So there's no earnings for the coming month in HPQ, and you're talking about stocks with a 35% implied volatility is rich for HPQ, just in light of what's going on here. Let's go to the next one. U.S. Steel, it has earnings on 4/30, which is just 6 days from now, but stock's trading for 16.18. It has really decent implied volatility at 43%, probably on its way to, earnings-wise. I'm guessing earnings-wise, it'll probably get up to about 60, but the back month volatility may be an interesting time if you're looking to get long U.S. Steel by selling potentially June puts. And let's go to the last slide. Zynga. Earnings are this afternoon, and the stock's trading for $3.18, and the implied volatility is 82, which is probably pretty average in there.
Correct. A little bit on the low end, about 40 percentile in the 52-week range.
Okay, so here's the neat thing about this, and this is why we did this today. And let me just make sure something. I think this is my last slide, right? Yes. Okay. So the reason we put this together was just to give you some idea of some of the stocks that you can mess around with learning. Like what I suggested to Case yesterday was, hey, you know what? You've got to do something, for example, like sell strangle. Just take one lot and just get used to doing something that you're allowed to do that fits your account. So you sort of just your mind is a sponge. It sucks everything up right now.
Sure.
Everything you do in every part of business and life, you are very impressionable, and you will take this stuff and build from it for the rest of your life. And most investors, we've never had a spot to build from. The world of investing has always been, here's my money, do the best you can, and I'll be happy with anything that's positive. And in the meantime, make sure you take care of yourself.
Right. And tell me a good story when you're done.
Yeah, imagine you go to a restaurant and you bring your own bottle of wine. Have you ever brought your own bottle of wine?
To a restaurant?
Yeah. Well,
yeah,
I don't
like a
usually do it.
BYOB?
Yeah.
Sure.
So you go BYOB, you bring your own bottle of wine. Well, you sit down at the table, and the waiter comes over.
You know what that is, right? Bring your own bottle. I mean, you don't know what suicide doors are, so I just don't want to make sure you're okay.
Well, I just
don't
found
talk
out.
about men's stuff with you if you don't understand.
I just found out what a suicide door was.
Okay.
Okay. Somebody wrote it and explained to me, which is nice. So let's say you go to a restaurant and you bring your own bottle of wine, and you sit down and the waiter takes your order, and you say, and he says, well, would you like some glasses for your bottle of wine? And you say, sure, I'd like some glasses. And so you pour out like 3 glasses of wine or 2 glasses of wine. And then how many glasses are in a bottle of wine? 4?
Sure.
Okay. So you pour out 3 glasses of wine, and the 4th one you give to the waiter. That's what investing is. Okay. Except you don't know how the food's going to be, but you just gave the waiter 1/4 of what you brought with you. So you go in and you plop your money down and you give away just about what?
But you feel good when you give the
you feel good when you give the waiter
or somebody a glass of wine.
You
but
do
you don't
feel
feel too good when you give away 25%.
Well, because you don't realize you're doing it.
Right.
In most cases, it's not 25%. It's as high as 40%. And all because of what? All because we didn't want to take the time to learn what we're doing. So what we're going to suggest here is let's walk through some of these steps and let's get ourselves in the habit of being able to do things that even if they have earnings coming up, even if we don't necessarily have something we want to do in there, let's talk about just some of the ways to just indoctrinate ourselves and to get the ball kind of rolling.
Okay. You want to take a look at one of those stocks?
I want to take a look at all the stocks. I want to do it really fast.
Okay.
So what I've done is I prepared just something which is which we're going to go through. So first, we're going to actually go through in the list that they put them up on the screen.
Okay. Facebook?
Facebook. First thing. And remember, let me just go to my page here. I've got to do this fast, but okay. So Facebook has earnings on 5/1, which means now if you're trading big or you're nervous, there's a lot of reasons why, with respect to Facebook, why you wouldn't necessarily jump in and do, there's a lot of reasons why if you trade all the time, you'd probably wait on Facebook. But there's also people that are just starting to get used to this stuff. And one of the things I want to do is say, hey, you know what? Let's take advantage. Can you open up June options for a second? Let's take advantage of this relatively decent pop in implied volatility and the relatively low basis in Facebook. And let's just look at some of the things that may be attractive to us. So for example, for starters, and is this a regular account or paper money?
It's paper money account.
Okay, so the actual margin requirements for Facebook are incorrect.
I'll give it to you. Go ahead.
Okay, so if you click on the June 23 puts, and you'd have to go to a regular account to see.
So you're bullish, right?
Yes.
Okay, so you're going to be selling the put.
That's right. I just want to show you something. So and hit confirm and send once.
The margin, good.
Hit confirm and send once. So the margin requirement is what, about $500? I think it's about right about 40%.
I got it's right.
Maybe they changed it back, which is good. Okay, so the margin requirement is $231. If you're talking about a relatively small account, and remember what we wrote up here, you can be 2%, 3%, 4%, whatever it is. an interesting way just to get involved in the industry, just start learning about managing your own money, is for a decent return on capital, which is, in this case, it's about here, close that up for a second. If you were using $231 and you were collecting 57 cents, you'd essentially be creating a 25% return on capital for 60 days. See the number on the left-hand side there, which says 58 days? There's 58 days to go to June expiration. Forget about earnings, forget about everything else. If you just jumped in here very small and said, hey, you know what, there is 6 60-day cycles over the course of the year, and I can put up $250 here to generate a 25% return for one of those 6 cycles, which if I like this approach, it's 150% annualized return for 6 times 25%, and that 25%, you see it right there, 25% return on capital.
With a 75% chance of taking that money.
It's all part of the learning process. You can't learn this stuff until you do it. Like, you don't know if you like that bottle of wine until you taste it.
Of course.
That's the whole point here. And I'm not saying that I don't know if that's a great comparison, but if you've never tasted wine before, you wouldn't know what it means.
Sure.
Let's go to the next one, just for quick. We got to go through these quickly.
Sure. I believe it was Groupon.
It is Groupon. What I suggested to Case yesterday in Groupon is, hey, you know what? Let's just get your feet wet in here. We're going to go, and Groupon earnings are on 5/8, so we're going to go to June, same way. And just to get your feet wet, we're going to sell one of the 7 calls and one of the 6 puts. Sell strangle. And what we're going to do here is you collect 97 cents. Now, let's just think about this. Hit confirm and send once. And I want you to just check the amount of capital required. But in this case, the amount of capital required, it's really low. I think it's higher than I think it's about... I'm
going to look right now.
Hang on, let me just get your real number because I don't want to use the wrong number.
$230. I'll round up.
So $230 is the capital required because it's a 40%, not 20. So $230 is the capital required to do this Groupon strangle. You're collecting almost, can you close this up for a second? You're collecting almost $1. So let's call it a 40% collection. Now, again, you have the same 60 days. So you have 6 of those cycles per year because it's on a calendar basis. So 6 times 40%. So the risk in this is the potential return on capital in Groupon is 240% a year. Potential return. Okay, it's 6 times 40%. And you can't, with a reasonably high probability of success. It's not that it's guaranteed to be a great trade. It's nothing like that. It's just, it's guaranteed to be a great learning experience, whatever happens in Groupon. Because what you're doing is you're teaching yourself how to manage what the industry has always called undefined, unsuitable risk, which truly is, if you put it in perspective against your potential return, it's suitable risk. Let's go next one.
US Steel X.
So same thing in X. Now, X has earnings on
4/30. A couple of days from now, 6 days.
So you have the same situation next. You're probably not going to stay away from the front month and give yourself a little duration, but you're going to take advantage of the pop in implied volatility. So what I like in X is I like going to the June 15 puts, and the return on capital in there is about 35% for 60 days. And just practicing with like a 1 lot. So what ends up happening in there is the worst that happens is you buy stock at $13.35. The best that happens is you make a 34% return for 60 days. And when you start to annualize that, it's like almost 200% a year. And that's the kind of just exposure to portfolio growth that you need to have in order to be a successful investor.
I was thinking that you might go with like an at the money call spread here too, like the 15, 17.
No, I'm just going with aggressive, naked stuff, just on a very small scale for tasty bite accounts. The amount of capital required to do that, Tony?
It's wrapped around $200.
Right. So $200, it's a 34% return on capital. Next one.
Zynga. Is it Zynga next or HPQ?
Well, it doesn't matter. We can do either one. Go to Zynga for a second. So in Zynga, the earnings are this afternoon. Now, Zynga, I feel it's a little bit harder for us. This would be the one stock where I think that, not because of the risk in Zynga, just because there's not that much there to do. But if you take May out of the equation and you look at June,
you're probably not going to do it, right? I mean, this is one that probably wouldn't fit.
If you wanted something for learning experience, okay,
even though the return on capital is the same, right? I mean,
if you wanted something for learning purposes, you may look at like the 3.5, because it's a ridiculously small amount of money that's required to do this. So you may look at the 3.5 spread in June, which I'm sorry, not the call spread, just the strangle, where you're selling the 3.5 calls for 25 cents. He's basically collecting a little over 50 cents.
Yeah, that's
53 cents. It's not the worst thing. It's a great learning experience.
Yeah.
Like, I would have no problem if Kay said today, I want to do a Zynga strangle for June. And it's not because I think, wow, that 53 cents is going to clean house. It's because, you know what? You have to learn
about the strategy.
That's right.
Sure.
And it's a minimal amount of capital required to do this. And it's the cheapest way to get in the game. And then finally,
there's a couple things that sticks out to me as just the platform in general. It looks really outdated, and really the spreads there are really tight, and I'm having trouble finding decent spreads when the market's open, especially right now. With the volatility, I'd say that has something to do with it. But yeah, very interesting to see there, and even trading a $3 stock. I mean, that's not out of the ball game here if it meets all the criteria. So it's interesting to see these kind of plays and playing them out, one by one, and especially with earnings coming up. So Interesting to see on a small account.
And the capital requirement on something like that's about $200 too. It's about the same.
$200 for everything. And because they raised the requirements.
$200 all you can eat.
That's kind of it. And then let's just go to Hewlett Packard very quickly. So Hewlett's a stock that's had a nice little sell-off, and there's no difference here. If you look at the return on capital.
521 is
right, so you can open up May in Hewlett. And when you look at some of the May, this would be a shorter time frame, but when you look at some of the opportunity in May, you can see how much different the return on capital is in May than it is in June. But again, in Hewlett, I actually probably like June better in here. And I like the 18, go back to June for a second. And I like the learning process, like, for example, the 18 puts in June and a 27% return on capital. I think it's even actually richer than May. So you're taking advantage of the pop and implied volatility for May. I'm sorry, for this earnings are what day?
June.
Oh, the earnings are in June. I take that back. You have to do May. I take that back. My apologies.
See, I thought the point that you were making there was because earnings are in June, you have a higher volatility, which gives you a return on capital. That's so
I know,
much
but
greater.
I don't want to wait for the. I don't want to wait for. I want to avoid. I want to avoid the last 2 weeks of the month where the pop volatility.
Well, because the return on capital is so low now, you're going to have to actually move to the 19 puts, right? And you can't do the 18 puts in May.
Hewlett is the one stock looking at these prices here where the return on capital doesn't excite me. So when I look at all 5 of those stocks, I think I must have looked at the Junes yesterday when I was preparing this. But when I looked at the Mays right now, it's the least exciting of the group.
And plus, you need about $350 to do that put.
Anyway, a good, quick discussion covering some opportunity in different underlyings for TastyBites.
Like it.
We'll come back. We'll do opening bell. Set up your screens, Bat. We're ready to go in Apple.
I'm ready to go in Apple, and we got the X Trader following that. So we'll be back in 90 seconds listening to Get Tasted only on TastyTrade Network.
All right, interesting to see. I was pulling up some of the stocks that they mentioned. And this is a monthly. I know they've mentioned monthlies instead of weeklies. It just depends on the volume here. But that's it. Seeing the spreads like they are, they're pretty wide. And this could be because the market's closed, but they had it where it was, like a penny wide or whatever, 2 pennies. So difficult to find right now. And that's, I'm kind of hesitating on that alone, just because if you get stuck in between the spread there and it's really wide, you're going to have a hard time getting out of the trade with a profit. And even if the price stays the same, it's going to hinder you. So, let's see. Keep an eye on that though. When earnings, I think they have earnings coming out September 3rd. So 27 days. So that's coming up. We're about in the same situation then. So anyways, just something to keep in mind. See some of the stocks that they were talking about way back then, and they're still tradable today. Let's look at our third video, hurdles to face, and then we'll finish.
And today I'm sticking to the theme that we started yesterday, and you'll see that in 1 second, because I just think that we have to even go into more depth than we've done. We just have to keep challenging the same kind of and be as repetitious as we can be, challenging the same ideas, same concepts, same strategies, and the same application of such. So TastyBites accounts between, let's call them $2,000, which is the minimum amount for a margin account, and $25,000, which is the cutoff for the pattern day trading rule. I wish it was something different, but that's the way it is. So let's just call it, 2 to 25,000, and that's a TastyBite account. One of the hurdles to face when you have a small account is you have to stay active. And again, it's difficult to stay active when a lot of your activity is limited. When Tony and I want to stay active, we'll do stuff like futures or options. We'll trade in and out of stuff. We think it's really important to kind of keep the juices flowing, keep the sweat going. And when you do that on a TastyBites account, it's very hard because you can't buy and sell the same instrument just because of some of the limitations. So hurdles to face.
And some limitations by the account, right? I mean, that's really what it comes down to.
They're regulatory limitations. Right. There's suitability limitations. Staying active and sticking to the plan of maintaining and monitoring 5 to 10 small positions in a trading account can prove to be a challenge, absent of a solid foundation rooted in rules and principles. You saw yesterday with Case, one of the things I tried to focus on with her is I said, hey, you only have 5 positions on. You need more positions. And it's very hard to tell somebody you need more positions as a reason for doing something, because remember what this whole business is about, this whole industry. Nobody says you need to have more positions. Everybody says you need to do this for this reason.
Correct.
It's always been you need to do what they used to say, trade smart, not often. I saw this. I don't remember where I saw it, but a bunch of different places.
Right.
Trade smart, not often. It's freaking half-ass backwards. It's idiots.
It makes no sense.
It makes
right.
absolutely no sense. It's completely the opposite, which is just do stuff for the sake of doing stuff and put on as many small positions as you can, because it's the only way to get better, to maintain activity. It's the only way to stick to your plan. And the hardest thing to get over is that hurdle. I talk to Casey about it all the time, and I say, she's like, I always thought investing was trying to do stuff that for some reason I had a reason for wanting to do it. I never understood how investing could be just putting on positions and trying to manage those positions.
Right. Until they're winners. Correct.
Right.
Agreed.
It's an extremely difficult concept, and I just want to spend about 30 more seconds on it, Tony.
Yeah, usually it's just listen, I'm going to pick a direction for the long haul. Maybe the long haul's the rest of my life. I'm probably going to be in this mutual fund or in this product until I'm not anymore. Meaning when I'm like 70, I take the money out.
It flies in the face of what everybody's always been taught, which is, hey, find a good company, find a stock you like, find a reason for.
Wait until they send you a gold watch 50 years later,
That's right.
which doesn't come.
And it goes completely in the face of that, which we basically say is, I don't care why you do the trade.
Right.
Listen, you're going to see it today when we have these two guys on, and when these two guys are here, I don't care what they do, as long as they define the risk, they keep the size to what we're limiting them to, they put the number of trades on that we're making, they create positive data, and the probability of success on every single trade they make is better than 50-50.
Other than that, the world
I
is
couldn't
your
care
oyster.
less. I'm going to go off on a tangent for just a quick second.
Sure.
Who
can stop you?
About 10 years ago, we created this class, which was, I called it a high probability class, or whatever. We wrote it.
Yeah, I'm familiar with it.
I know you are. And we gave this class for a lot of years, like 8 years or something, like 8 or 9 years. At the end of this class, we used to say, we'll put up about, whatever the amount of money was, like 50 grand. Usually it's around 50 grand. And we put it up in increments of $5,000. And when we put up the 50 grand, we say to a group of people that were attending the class, students in the class, we say, do whatever you want to do. Here's the only thing. You have to create positive decay. You have to choose from the list of liquid stocks we have, and you can't do more than $500 per trade. That's
Correct.
it.
Correct.
You can't use more than $500 per trade. Other than that, we really don't care what you do. You have to define your risk. Okay. We don't care if you get long or short by delta. We only care that you, in the end, that you create positive decay and you have a higher probability of success than winning than losing. That's
Right.
it.
When you put on the trade.
And we don't care what you do. Now, who in the world would do that?
Right.
Nobody in their free freaking mind would do that. Warren Buffett included. I'm sorry, but nobody would ever think of investing that
With
way.
100 people in the room and they're real money. Yeah, no, you're right.
And over 8 years and doing this thing for whatever number of times it is, it's ridiculous. I shouldn't say it's ridiculous how much money we make, 'cause I don't know. I don't think that's fair.
The results were never technically audited, but the results were fantastic.
We basically made money every single year. That's the
Correct.
simplest way. I don't have to
And
talk
that
about
was
that.
and that was through 08. It was through multiple
Everything.
different market conditions.
And it was through that process that we came up with TastyTrade, because we're like, you know what? It really doesn't matter, because these positions always look, in the end, everything looks the same. So staying active, sticking
And the
to
management part of it was the second half of that, if I could just for a minute there. I mean, you really didn't do anything. We had a weekly call, similar to like what we do on Good Trade, Bad Trade. We just have a time during the week when we would get together and talk about what we might do to the positions the following day, meaning that market timing really wasn't even part of it. It was just what the strategies dictated.
Yeah, if we had, we basically managed it like a monkey would manage it. If we had somebody that was like halfway intelligent, that kind of, it would be really cool.
Personable really didn't know English that
That's
well.
right.
English was the second language because it was me, right?
Okay.
Got it.
Staying active and
That's
sticking
my
to a
buddy.
plan of maintaining and monitoring 5 to 10 small positions. I hope Case is listening, because this is the reason we do it. In a small trading account can also prove to be a challenge. So let's go to the next slide. So some of the hurdles to face. Some of the challenges include keeping expectations in line, especially during periods when the market has low volatility. You know what? Expectations meaning it's just hard to find stuff to do.
Right.
So the expectations for return go down based on opportunity. Isn't that the way it is anywhere, though? Like if you have if you own a store or a business and your products are hot, okay, your expectations for business are obviously better. Let's just say, for example, you own a Apple store and then I own a PC store. Okay, your expectations are going to be higher than mine.
That's correct.
All right, that's it. Keeping positions small and no more than 4% of total capital per trade. That 4% is not a real number. That 4% is just a number.
Right.
We're on larger accounts, it's between 0.5% and maybe 1.5%. And that depends on whether it's defined risk or undefined risk. On smaller accounts, it's very hard to get much smaller than 3, 4, 5%. Because if you're talking about, a $10,000 account, you can get down to 2%. But if you're talking about a $2,000 account, it's hard to get under 5%. That's all it is.
Correct.
And if you're talking about a $20,000 account, you can get to 1% undefined risk trades. So it really just depends kind of what you're talking about. I'm sorry, what you're comfortable with, what kind of spreads, that kind of thing. let's talk about selling a put spread today because we just don't have time to go through everything else. One strategy that we like to use in our portfolio sometimes is selling a put spread. But yesterday, when volatility is cheap, I actually don't like put spreads that much. But we talked about selling naked puts.
Because you get paid more with a high volatility
Right.
for selling that naked put, taking the risk.
So what I really wanted this segment to be on is selling a put spread in a leveraged or inverse ETF, which is the equivalent to the contrarian play. So this is when we sell a put to collect premium, buy a put at a lower strike to define our risk while lowering our margin requirement or our buying power reduction. You're going to see a lot today using the acronym BPR, which is buying power reduction. Let's go next slide. So I'm going to use the same stock that we actually put a position on yesterday. Didn't we sell a naked put in TZA?
We did
Okay.
yesterday.
So we put a naked put on in TZA. We talked about how much capital required. I believe it was like $3,000 to do a one lot.
Correct. $2,950
Okay.
bucks.
So the difference is when we sell a put spread in a stock like TZA, for which we could do for smaller accounts, we generally like to go out to the next expiration cycle, which in this case is June. We like to sell the puts that have a 68% probability of being out of the money, exactly like we talked about yesterday. But we also, in this case, buy a put at a lower price during the same expiration, which is known as a vertical spread. If you go to the next slide. So what we did here is we just kind of outlined it for you. So we took the TZA, which is the small cap, the Russell 2000 bear fund. It's 3 times leverage. The current stock price is $36.35,
which means it's going to move 3 times as fast, right? That's what the 3-time leverage means.
It has 3 times the volatility.
Yes.
And so the put strike is 33, the short strike, the long strike 30. The credit received is a total of 89 cents, which is 31 cents minus $1.20. The margin for the naked 33 put, what strike do we say? 33 put?
Correct.
So the margin for the naked 33 put, which we sold yesterday, was 3,000. The margin for the spread is 223. You can guess that your return on capital is going to be sharply higher.
Sure. And the 33 put was trading for, when we did it around, well, it's $1.20 there, so all the numbers are good. It was like $1.08. All we're trying to do is showing you, you're not giving up that much more. Obviously, it's 31 cents because that's what the 30 put cost to buy.
Exactly. But the difference in capital, it's over, it's
substantial.
13 times the amount of capital. So the first thing that registers in your mind is, wow, that means my return on capital is going to be that much greater.
Of course.
Let's go next slide. I think there is one more.
Actually, 2 more.
Okay. Keys to success. We sold one June 33 put for $1.20 credit, whereas the margin requirement on that would have been $2,950. We also bought one June put at a lower strike price for $30. So doing this, we lowered our margin to $223 while netting an 89-cent credit. So you take a smaller credit, a higher return on capital, a lower probability of success, and use a lot less capital.
Correct.
Which is easier to manage? Well, the naked put's easier to manage, believe it or not.
Yes.
Let's go to the next slide. This is just one of the many strategies that a small trading account can use to generate returns on a leveraged or 3x times inverse ETF. By reducing margin, we give up some of the potential income, but we have to find stuff that has a high volatility. So we also will reduce risk, thus allowing us to remain consistent with our overall trade plan, fit inside of a TastyBites account. And whereas yesterday, that was a heavy margin to pay, but I wanted to show the example. Today, it's just a way to get around that to use a lot less capital.
Sure. No, it's good points. Good points.
Okay.
Yeah, no, it's good points. You also could do 2 spreads or 3 spreads or 4 spreads. I mean, if you wanted to ramp it up, if you get to that point in the TastyBites account. I mean, it's all about trying to ramp it up when you get comfortable, right?
Absolutely. 8:25. It is again Wednesday, May 1st. We start a new cycle today. Let's wipe the slate clean. Pat, let's have a monster month in May.
You're off to a good start, and we got the opening bell coming up next. You listen to Get Tasty on the TastyTrade Network.
Yeah, I haven't heard of that ETF before, TZA. It says the Bear Fund, so I have to look into that. I've got it pulled up right here. So yeah, they're just kind of breaking down that trade, right? They're doing a put spread on this for an example, and that was way back, May 1st, 2013, so it doesn't apply today. But just kind of looking at these stocks as he mentions them and seeing how they trade those put spreads. I'm doing that in my small account, just doing one strike wide, just testing it out as I go and seeing how that plays out. It's been really trying, but also, it helps to try it out, especially when the market is on the downturn, to see how much risk I actually have on. And I want to show, let's see if I can pull it up here before we close. I have So I'll have this on a separate video, but I want to show you guys. So last week I lost like 10% and that was with the wheel strategy. But even through that, even though that happened, and it's the same kind of drop that we had whenever I lost half my account, you can see the difference in the drop here compared to what happened whenever I had way too much size on and the market turned around. So I feel like even though my account is back to where it was, it's given the market we've just been given last week, it's good to see that I'm not going down any further or to that kind of magnitude, right? I'm not losing half my account. It's a manageable amount, and I'm still able to place trades to adjust to the market conditions because I didn't use my full account when doing the put spreads, iron condors, and things like that. So I'll give an update on how last week went, but just wanted to share with you just kind of the magnitude difference between the last time the S&P 500 went down and corrected, and then this time when it went down. So just kind of interesting to see there. I feel better, than I did whenever I lost half my account. I feel like I'm managing that decently well. The other, of course, looking back, hindsight's 2020, is I could have had more call spreads on because the market it looked like it was kind of downtrending there. So anyways, just kind of being more market aware and knowing that, okay, the jobs report was going to be coming out. I didn't pay attention to that. So I'm going to be looking for some kind of calendar, something like that I can keep track of these important events that come up in the market, and I can be better prepared. And it's ultimately a good way to be mindful of those days and, just to be ready when they come, and also try to keep my account on the delta neutral side. And right now I'm at around like 36, I believe. 35 on the delta. So I'd like to try to get that as neutral as possible. Most of that is from the wheel strategy itself. So I'm going to be limiting my wheel strategy plays and then focusing more on these tasty trades from Tasty Live, doing the put spreads, iron condors on a very small scale. So yep, there's the 3 videos. Got some really decent lessons there, and not really anything on the objective side. Just going through, they pretty well just went through some trades and showed us some examples on what they were doing and their thought process, looking for high IV, high percentile implied volatility. Getting at least a third of the width of strike on put spreads, call spreads, and choosing very tight spreads. So again, just hammering home those things, and they actually went through some trades with us, which is really good to see there. We'll have 3 more videos coming out. We'll be going over this again. I like the idea of doing this on a Friday and Saturday, so I may just keep that going like it is on Friday and Saturday. So I'll probably have a live stream then, and so stay tuned and be looking for that notification when I go live, and we'll see you next week.